Welcome to Spidell's Federal Tax Minute. I'm your host, Catherine Zidane, and this week we're covering the advantages and disadvantages of the married filing separate filing status. We covered this topic in a longer article in a past issue of Spidell's Federal Tax Letter, and you can get information on this monthly publication at spidell.com under Publications. The general rule is that married taxpayers who file jointly fare better tax-wise, but that's not always the case. It may pay to examine your married client's situations to see if they might be better off filing a married filing separate return. The biggest advantage to filing separately is it may, but doesn't always, subject both spouses' income to lower tax rates, but there's frequently a cost in terms of lost tax benefits. The only way to truly determine whether married taxpayers are better off is to run the numbers as if the spouses filed jointly and then separately and compare. Here are situations where you might consider filing separate returns. If your client is concerned about accepting full liability for any taxes owed now or later as a result of a tax audit, don't leave your client holding the bag for a spouse who underreports income or overreports deductions. If one spouse owes back taxes from before the marriage, back child support payments, or unpaid federal student loans, filing a separate return may keep the non-debtor's tax refunds from being taken by the IRS or another agency for the other's old debts. File separately if the client's state imposes a higher tax on wealthy individuals. For example, California imposes an additional 1% tax on taxpayers with taxable income in excess of $1 million, and New York increases its tax rate by almost 3% for taxpayers with income in excess of $1.077 million, and even more for taxpayers with income in excess of $5 million. Taxpayers who live in community property states will need to evaluate whether filing separately will help avoid the higher tax rate. Residency and sourcing issues may allow one of the spouses to avoid being taxed in a higher rate state if only one of the spouse's income is sourced to the higher tax rate state. This can come into play if one of the spouses works in a different state, full or part-time, or has rental income from another state. Also consider whether the income-generating state is a community property state. Consider filing separately if the taxpayers live together and want to force a passive activity loss to be suspended, if the taxpayers have disproportionate medical expenses and filing separate tax returns will allow the spouse with the higher medical expenses to claim medical expense deductions, or if the spouses live apart and one may qualify as head of household and for the higher standard deduction available to head of household taxpayers. State laws have no direct impact on federal tax laws, so why do state community property laws and other similar state laws matter for federal tax purposes? The answer is subtle but important. A taxpayer's federal tax obligations are determined solely under federal law, but a person's property rights are determined under state law. In situations where federal tax law looks to a taxpayer's property rights first before applying federal tax law to the taxpayer's scenario, a state's property rights laws will come into play. Areas of state law that determine property rights include, among others, community property laws that define property rights between spouses, real estate laws that determine the rightful owner of real property, such as the death of a joint tenant or a tenant in common, and corporate laws that determine whether an entity has been organized as a corporation, LLC, or partnership. Married taxpayers who file separately generally cannot claim the following tax benefits: the Earned Income Tax Credit, the Dependent Care Credit, the American Opportunity Tax Credit or Lifetime Learning Credit, premium tax credits unless the taxpayer is a victim of domestic abuse, student loan interest deduction, the partial Social Security benefit exclusion, the standard deduction if their spouse itemizes their deduction, because both have to itemize if one spouse itemizes, and any exclusion of interest on Series EE or U.S. savings bonds used for higher education expenses. Also, if the married taxpayers are living together and file separately, they cannot claim the $25,000 passive activity loss allowance for rental property or the credit for the elderly or disabled, and they could lose all or part of their IRA deduction because the AGI phase-out amount starts at $0 and it completely phases out at $10,000 for separate returns, and the taxpayer is considered covered by a retirement plan if the spouse was covered. If you're looking for a tax update course before the start of tax season, check out Spidel's Federal Tax Update webinar on January 5th and 6th. You can see which topics we'll be covering in this 8-hour course and get registered at spidel.com. That's all for this week. Join us next time for another episode of Spidel's Federal Tax Minute.